All right, so we are established in this bearish pullback we have, but it's interesting. It's not your typical pullback where a volatility pop and a lot of damage early, and you break down, and then we just kind of bounce up and down around the lows. This has been more of a grinding pullback where we've been steadily getting to the bearish signs that signify all these pullbacks, and we're not really to the worst part yet. And it appears that we are grinding our way without a pop to the worst part. And there's actually precedent for that. So I'm going to talk about what that precedent is, and very, very recent precedent, and very interesting precedent because it's a similar type of rally that we had that preceded that pullback, and very similar to the rally that we had here. Not in the extent, obviously this was like a record move off those March lows, but the same type of move. So let's go ahead and break it down and get started. Today is Wednesday, September the 23rd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. You can see the pullback we're getting, another day of dark pink shading and red line, and today, for the first time, closing below that 23% retracement level of this big, long, 5-month intermediate rally that culminated with that overbought cluster there. On, what was that, September the 2nd. So pretty much this entire month for the last 3 weeks has been, we've been coming down from that cluster. And for the first time, finally getting through that 23% line. And you see it at the bottom, we got a bounce in short-term sentiment yesterday with the near-term line popping up above 50. And for the second time, getting a bearish near-term high. Lower highs here, lower highs with highs between 50 and 80 on the near-term line. The benefit, and here's the nice thing, why it might not be that bearish, why this might be kind of a grind instead of a free fall to the downside. Again, similar to May of 2019. I'll come back to that here in a minute. Is the near-term line, when it does fall, you notice it's not getting in the reversal zone. Like, so over here, when we really tanked hard, short-term sentiment got down to a low on February 24th, that day after, where we got that runaway gap, and we got that, which we haven't gotten a runaway gap here, but we got that runaway gap on the 24th. The short-term sentiment, the momentum line got down to 6, almost down below that 5th percentile, and the near-term line was at 10. The very next day, it did get below the 5th percentile, and the near-term line got to the 5th percentile. So it's a very extreme moves on short-term sentiment during that decline. We're not really seeing that. We are getting the momentum line down, but not accompanied by a sharp drop in the near term. A lot of that's because there's a little bit of a long lower shadows that we've been getting. Today is kind of the only day so far that we haven't had some kind of lower shadow buying into the close. We little tiny one, but just a little tiny one. So that, of course, most of the selling is occurring in the NASDAQ, and you notice its near-term line is actually still up above 50. Its short-term sentiment was really strong. This last 2 days pop was very strong. Got us back above the 23% level yesterday before closing back down today. It's like the S&P, its intermediate line is in the reversal zone. Its momentum line is down to an extreme low. The near-term line back down below the market sentiment. Where we're not seeing as much weakness is in the Russell 2000. Now it's kind of catching up in the last few days. So Monday and today you can see the weakness there to the point where we've almost got an oversold cluster with the intermediate line. Not in the reversal zone like it is on the NASDAQ and the S&P, but pretty close. And not below the 23% line like it is on the S&P and the NASDAQ. The Dow Jones Industrial Average, you can see, is actually above its 23% retracement level. And it's near intermediate line also up above the 20th percentile too. So we're getting more and more oversold. If I go back to that May 2019 level, and a lot of market scholars in our classes have heard me talk about this quite a bit. The market forecast, when we eventually did drop down, the near-term line made its way down to the reversal zone, got down below the 10th percentile. In fact, got down to the 5th percentile. It's been just a couple of days down there, culminating with that overbought cluster. That same day was also the end of a week. So when you look at it from a weekly perspective, here is the week that was. So May, right there, the May 2000. It got down to the moving average, mind you, after a move up where we got dark green shading and a yellow line. Then that line turned green by the time we got this little decline. If you notice, the near-term line for the weekly chart got below the 10th percentile that at the end of that week. So we finished down at 9.5. Right now, you'll notice we are at 6.5. So very, very sharp drop in short-term sentiment and oversold momentum line. We've seen the oversold momentum lines on the weekly chart that kind of pops. So there's the last one we got, and then we got this one, and the pop-up we got after that. And of course, during this decline, we had this one. You can see the pop-up we had the next week, and then we came back down, finished with that cluster, and then we popped up for the next so many weeks after that. So you can kind of go through and see lots of examples of the momentum line. Now, granted, the week's still 2 days from being over. If we get a long lower shadow this week, that short-term sentiment is going to pop up pretty sharply. But you can kind of get an idea of how like we've seen this before, and we saw it back in May of 2019 in a very similar type of move, coming off of a sharp death cross low point, getting up to with a sharp move up to pre-COVID highs, this one a little bit higher, and then the move back down, in this case to the 30-week moving average. That was to the 23% retracement there on the initial decline, then to the 38%. 23% retracement here so far, potentially to 38. Would get down to the moving average if that was the case. Doubtful we'll get that far, at least on the S&P 500. Then you look at the monthly chart for that same, because that week in May was also the end of the month for May. That Friday was the last day of the month. So right here, that was the monthly chart. If you notice the monthly, I need to switch this to month. There we go. So right here, sorry, where'd it go? May, right there. May 2019, you can see the monthly momentum line got down below the 5th percentile, got extremely low. The near-term line had fallen, but not below the 50th percentile after coming off of a pretty strong high point. Look at this, same thing. Momentum line dropping down. Now, granted, we have a week left for this, so we get a long lower shadow, that story changes. So we'll see how we end up finishing by next Wednesday. But you can see the exact same type of pattern. And I've talked about this before, how I've alluded to this pullback that we're getting here being very similar to May 2019. And then the rally we had for about a month after that, because again, that was a pretty long, it was like a 4-month long. This one was 5 months long. We had a really good run off of that low. Then we had this kind of a grinding pullback because there really wasn't a big pop at all in volatility there. Then we rallied, and then we had this, little bit of an August swoon, a little bit of an interruption there in October. And then despite that interruption, which was an intermediate pullback because we didn't get dark pink shading in a red line, we had another good long intermediate rally that finished this long-term run here by the time all was said and done. So very, very similar pattern developing here, depending upon how we finish, right? We're only at 13, so we're not below 10 yet on the daily intermediate line. But we'll see how we finish if the selling continues down towards 31, 36. And whether that happens in a day or 2 days by the end of the week this week, if not, if it happens by the end of the week this week, there's a very good chance that the weekly chart looks bearish. Very good chance we get below 10 on the intermediate line. And then, of course, even no matter what happens the first 3 days of next week, very good chance the monthly candle stays down at those really sharp low points too. Again, depending upon how long the lower shadow is. It's kind of hard to finish a month at the very, very low. So we'll see how that ends up playing out. But it's an interesting pattern. We didn't go too far. Like I said, 38% Fibonacci retracement, and went from May to the end of May. It was only a month-long decline from high to low. And we're getting the same thing here, beginning of September, potentially to the end of September. And we kind of get an idea of where it might end up. And it's a slow grind, which is very nice because that was a slow grind. And not a whole lot of damage done. Not a whole lot of people going nuts or crazy unless you got really bullish right here, which we never talked about doing. And even with the market going up as much as it did with 3 clusters in that time frame, the more bullish you got here, yes, this is going to be very painful for you. But for most market scholars, we've been really focusing on reducing risk during that run. During this decline, not nearly as painful. And with the hedges we've been talking about in classes lately, and even with the trade that we did in NVIDIA, as an example here in a Market Outlook video, then we can actually be okay. In fact, we did a trade on Apple on that September the 2nd, September the 3rd. I think that one was on September the 2nd. In our market outlook video, a hedge trade on that, and we've done a hedge trade on NVIDIA. So I've given you some examples of the type of hedges you can do. I've also given you plenty of examples of the type of bullish trades you can do here recently, as well as the type of trades that we did during most of that 2.5-month long rally. That ends up putting us in a much better situation going into September expiration than we would have been had we been loading up on the bullish deltas. Hey, before I look at show you some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today, that's not surprising. Number two, it tells us that you want us to do another video tomorrow. You know, if that's the case, if you like our videos, you want us to do more, you want to tell us, let us know with one click. You can do that right now while you're watching. Of course, if you don't like our videos, if you don't want us to do any more videos, then you don't have to click on anything. Of course, you don't have to watch either. Also, while you're down at the bottom, comment. What did you get out of the video today? What stood out to you? What questions or comments? As people come to the videos, they read the comments section, right? So what stood out to you in today's video? Share that with other viewers down in the comments section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching our video on our blog, check out some of the other things over here on the right, including our Market Outlook live video. So I did one of these today at 3:30 Eastern time. All of our monthly and our premium subscribers, our plus subscription is our monthly subscription. All of our subscribers get access to this. We look at all the old trade ideas that we put on. In fact, all the trades that we did actually had a good day. We were positive in those trades. We reviewed them today. We actually closed out one, and then we put on today's trade idea before the market closed. So check that out there. Again, all you need is a monthly subscription for that. And then you also have all of our classes. Now our Q&A sessions here, you can see Brandon's got a Q&A tomorrow. That is for our premium subscribers. I do one, Brandon does one every week. But the other 8 trading rooms are all available for all of our subscribers, again, our monthly and our premium. Of course, our premium subscribers get access to all of our charting tools, as well as other tools that we create on our site, as well as access to our community, our class forums, where we have other discussions and other custom content. Finally, come down here at the bottom, click on this heart. It opens up a new window there. Hit that like button. Also hit the thumbs up right here. That opens up this new tab to your Facebook page. Hit that like button. Again, the more you do that, the more our content gets seen by more than just 148 people, just because I have a lot more followers than that. But they only show content that's engaging, that has likes, that has the likes and retweets, so to speak. So that's why we ask you for that, and then it also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. All right, let's get back to the charts here and let's take a look at the weekly chart. And you can see, as I mentioned in Monday's video, that's a more bearish weekly candle, and it's getting more bearish. And you can see we're below the 50-day moving average, which is now falling, and we are flirting again, like I said, with that 23% retracement level. Again, that May 2019, that's what we did over here. We had 1, 2, 3, 4, 5 weeks, and that 5th week was a transition candle before we turned back to the upside there, and that would be the last week right there in May. And we're 3 weeks into this now, and potentially a 4th next week, going into at least Wednesdays, right into Wednesdays, and we'll see how that ends up working out. But again, lower low, lower close, lower shadow. Right now, next week's open, depending upon where we finish the close, right? And you can see how much that close has changed. But we're at 33.20 is where next week's open will be, roughly, in that area. And right now, we're trading at 32.36, almost 100 points lower, which means next week's candle is going to be pretty bearish, too. At least start out that way. How we finish, obviously, you got 5 days. But it's going to start out that way, depending upon also, too, whether we gap. And I don't think we'll gap up huge on Monday. You can see the candles on all the other charts, looking pretty bearish, except for the Russell 2000. And the Russell 2000, you notice, this is kind of the first week. And you also notice, too, here, that it's, again, when we talk about like margin of safety and like the Nasdaq's got so much room to go down, to the 38% Fibonacci retracement, which is well above the 200-day moving average. The S&P's 200-day moving average is is the 200-day moving average. So again, the Nasdaq's 200-day moving average, is below the 38 Fibonacci retracement level. The S&P, the 200-day moving average, is above the 38% Fibonacci, but there's still some room to go below the 23. Well, you look at the Russell, and the Russell is 200-day moving average is above the 23% retracement. So we just haven't really been able to take off. There's your pre-COVID highs. We haven't been able to take off, and so as a result, it doesn't have as much room to fall. This might be all that we go down to, maybe down to 14.19, maybe down to that 62%. There will be some support there, but that might be all we get on the Russell. So there's more downside in these big tech names than there is right now in everything else, right? In these other areas. Even though there are some areas like materials and the S&P that are kind of showing some weakness. We'll talk about that a little bit later in the video. Let's take a look at the 3 green arrow chart, and you notice that the 3 green arrow, we still have 3 red arrows and a bump in volume from yesterday's with today's downward move. It didn't quite close below Monday's low point, but again, first time we've closed below the 23% retracement. When you look at the 2-line version of that chart, that MACD is heading lower, the histogram is getting bigger, the stochastic's still in the reversal zone. It did briefly pop up there, but still in the reversal zone, and we're still below a falling 8-day moving average, which is below a 17-day moving average, which is below both of them falling below the 30-day moving average. So again, let me go back to that May 2019 time frame, so a comparison to what we saw over here, and you can see kind of the same thing. We got down, we made a couple of runs up to it, we got below. You notice the stochastics didn't really fall too hard. The MACD, came down, bounced back up, started to work its way lower, got to the 17-day moving average, couldn't get above it until right there, and that's when things changed there at the beginning of June. So very, very similar. In fact, if you take a look at the DMI, and I think I might have mentioned this before in another video, but usually you get your biggest moves on a bearish decline early on, right at the very beginning. You can even see it over here on that brief little correction, or whatever you want to call that pullback there. But if you go back to May, and you can see some other examples, like there's the biggest move on the DMI right early on, and then over here we had a big move early on. We had a big move right here early on. But over here in May, we didn't get the big move early on. We ended up getting the biggest move late during the pullback when we hit the 38%. Very similar to what we may be seeing right now, where most of the biggest move, we didn't get very much of a big move here early. We're getting a little bit of a bigger move now, and we might end up getting the biggest move by the time we're all said and done. It is a bearish pattern. We're above 30 on the negative. We're below 20 on the positive. So that's a bearish pattern. But you get the idea that we're kind of working our way towards like in 2019, again, that May 2019 period right here, we worked our way to the worst level. You can see this is the lowest RSI. The RSI got below 30 over here on the day of the cluster. We got below negative. We got the closest to negative 200 over here. Right before that. So we worked our way to the worst case scenario there. We weren't so bad initially, and then we got our lowest levels here on that drop. That might be the case again here. We are below 40, but we're not below negative 200. We might be working our way gradually over the course of this month towards the worst levels. Now again, are we going to pop back up like we did back in May? I don't think so, because here it was very easy for us to pop up. I think it'd be more like this kind of pop up, where we pop up enough, maybe retest some highs or get close. Probably not retest exactly, but we pop up, but then we have another little dip because of the election cycle and the volatility associated with that. Very similar to the 2018 time frame, to the beginning of 2018 over here, where we popped up and we had some ups and downs, and then finally came back down. And this was a 3-month-long cycle to get us going again. I can see something very similar to that coming after this type of decline. So not this big type of decline where we get the big drop early, the damage done early, but this kind of decline like in May of 19, but we gradually go up and down before we finally get a good trend going by the time all is said and done there. All right, now let's take a look at the intraday and look at that move. Go all the way down pretty much to Monday's low points. Low of the week, surge in volume here at the end of the day when we really had the selling there. Again, we are below the value area of the 4-week range, which is up in this chunk. So, and we filled in that gap by the end of this morning. So where I thought maybe yesterday might have been the day where we had the high of the day early and the low of the day late, it actually ended up being a day later. So we got up and finished the gap, because we didn't finish the gap there early Tuesday morning, but we did early this morning, and then fell throughout the rest of the day. Bigger move, not a surge, but bigger move in volume, 93 million shares. The trading range today at 9 points. Those are all bearish numbers, right? When you look at the level here. So 9 points is way up here. The volume, though, not so much. And the ATR, it's against 1 day, and we'll see how things turn out. You could take a look at the daily moves here, and it's a 2% move, and we've had a lot of 2% moves, but again, that's very typical of the end of a bearish cycle. I saw somebody was mentioning that we've had so many bearish move or 2% drops. As we had a few over here in 15 and 16, but you see here, and we had some in 11, into 12 as well. But really, you had the biggest chunk right here again at the end of a bear market. You had all these, during the bear market, you had all these 2% drops. Actually, at the beginning, right before, at the end of the bull market. Then during most of the bear market, we had these 2% drops, and then that's how it ended. And then we rallied from there. And if you go back to 2000, same thing. We had a lot of 2% drops, and then look at all of them here clustered at the end here in July of 2002, and eventually we bounced off of that in early March of 2003, and we rallied. So again, you go back to now, and beginning of 2018 to the fourth quarter of 18, we got a lot of 2% drops here. That's where I think the bear market started. And then we went in 2019 with a little bit, and then we get the big surge towards the end. And now we're getting a little bit more here. But I think it's just that. I don't think we're going to go beyond. And again, it wasn't that same. We had a 3% drop just a couple weeks ago, and we didn't get very much of a gap to the downside at all today. We actually gapped up to the downside. So we'll see how that plays out tomorrow. Looks like, as of right now, a little bit of a gap to the downside here. The other thing, too, that stands out is volatility. Again, not even into the neutral zone. So volatility is jumping, but not jumping very high, which is another sign that we're grinding towards the worst scenario, the most of the damage. Again, going back to May of 2019, we had a little bit of a jump here, and then we had that last little pop above 100% after coming down. Well, instead of popping to 100 and coming down to 90, we popped up to 95 and we came down to 85. And now you expect another pop, maybe up to 100. But then at the end of this little intermediate pullback, and then, like I said, the bounce off of these lows will probably take a month or two, another month or two, since this pullback so far is taking a month to get to these lows. But like I said before, when you look at the Bollinger Bands, I mean, we are pretty darn close on SPY to important support levels. Same thing with IWM. IWM actually went a little bit below it to the 23% level, and you have another one there at the 62. So very, very strong supports in this spot. And then Diamonds was the other, where here we are. And even if we go a little bit below that point of control, you can see about the 260, it can go a little bit below that, and before it gets to its 38% retracement. Here is the 38% retracement of its decline. So we come here to that low, up to this high point. There's the 23% level now, and the 38 sitting essentially right on that 62% level. So lots of support down here. Not exactly the same for QQQ. Much bigger room for it to fall to get to its 38%, if not down towards the pre-COVID high point, or at least the top of the value area there around 244. It's got, again, a worse margin of safety, so more opportunity for a decline in that space. All right, so to summarize the technical outlook before we look at these intermarket relationships and sector rotation, again, it appears that this is going to be the type of intermediate pullback that we are in. That is not where most of the damage is done early in a big, strong pop in volatility, and then we just kind of meander. This is more like we've seen another example of this coming off of strong low point 2 in early 2019. where we also were grinding towards Fibonacci support as well as volume support, and finished with some very bullish patterns on that pullback on the market forecast chart that we appear to be headed towards on the market forecast this month. So very, very similar type move, where again the worst low, the worst selling occurred late. Now again, we bounced right off of that in May. I don't think necessarily we'll bounce right off of that here in October, because I expect October to be a pretty volatile month. But I don't think all of the volatility in October will be to the downside. I think there'll be some ups and some downs. We might end up finishing the end of the month on an upward swing for all we know. But until we get through that election, there's going to be some volatility. So there's going to be some ups and some downs coming off of very oversold short-term conditions, and then coming back down from some relatively short-term overbought conditions, 17-day moving average, maybe the 30-day moving average, and then roll back over to these lows again until we can get through this period of volatility and the VIX can drop and we can start a new steady intermediate run again. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Comment down there as to why. What are you seeing that suggests why you're a lot more bullish or a lot more bearish? And share that chart or indicator or whatever it is that's driving your opinion there. I know everybody's got an opinion, but it's more important to kind of see what's driving that. What chart, what evidence is driving that opinion as to, again, why you're either a lot more bullish or a lot more bearish. All right, now let's take a look at how things are moving from this peak on September the 2nd, how that's continuing to move into early this week. So there's the peak on December the 2nd there. We'll just use an hourly chart. Again, the Qs are the biggest loser, down 12%. All U.S. stocks are the biggest losers. In fact, emerging markets and developed markets are holding up relatively well, about half the losses that you're seeing developed versus S&P and emerging versus QQQ here. Interestingly enough, and really it's been over this week, if I were to transition now into just this week the dollar has been the biggest mover to the upside. And the Qs have actually had a better week because of their gain early coming off of that gap down. Their gain early and coming down. And IWM has been the biggest loser. And again, so it kind of shows that, like, there's a little bit of a catch-up trade down there, but it also shows too that there's no great rotation going on between these tech names. These tech names are, they're outperformers. They've pulled back since September the 2nd. They got the worst margin of safety, but during these little mini, these kind of short-term moves, they're still the leadership, and they're exhibiting that leadership here. And there's a little bit of a risk-off. The difference on the risk-off pattern is we're not seeing, there's a really strong move to the upside in the dollar today. And as of right now, this is actually tomorrow's candle. It's starting right now. 24-hour market is forming an oversold cluster. And you can also see, too, we're getting close to its own supports. If I zoom out here, and you can see where these Fibonacci lines are drawn on this decline from where this bear market started in 2018, but with a strengthening dollar. So here's the bull market move so far, and a little bit of a pullback. So dark pink shading in a red line, but already to a potential cluster. Again, this is tomorrow's candle. It's got the cluster, so we'll see how things end up shaking out. But you can see where you got up to the 62% retracement. We're pulling back down. We've gone through the 23% line, but we'll probably come down towards this 50%, 38% level, maybe towards 115.5 before all is said and done on the dollar's rally. And of course, that's had an impact on gold prices. So it's interesting to see gold dropping as sharply as it is, breaking into the Fibonacci retracement zone, and a little bit more of a downside move potentially to the bottom of that before that rally. But see, remember, this can go up. It has been. This can go up while stocks are bullish. This can go down when stocks are bearish. It's all dependent upon that dollar. If you take a look at commodity prices, you notice, well, here, let's look at the ETF, DBC. You notice we're not getting that big of a decline. I mean, we got dark pink shading, we got a red line, but we're not falling very much. If you see here from a Fibonacci retracement level, again, coming from this low point up to this high point there, we're sitting right at that 23% retracement. So that's a good sign that we're not seeing kind of broad weakness in this big, a big sell-off. You're seeing it in emerging markets too, not anywhere close to its 38 to Fibonacci retracement zone. Excuse me, it's still well above its 23% retracement level. So it's actually got some pretty, again, this is U.S. dominated. It's U.S. dominated, and you can see it still couldn't get really above this value area, but it's U.S. focused, and the bottom of the value area is sitting right at the 38% retracement if we even get down to that point. It's not a broad selling. It's very limited into very specific spots, and that's large cap tech. Looking at the biggest markets that are out there, so the 12 grid for the biggest markets here. Some of these emerging, some of these others. China's getting a cluster today. Italy getting a cluster today. Lots of dark pink shading, lots of red lines on this. But India, not so much. Korea, not so much. Japan, not so much. In fact, Japan's got a green line. And has barely got pink shading because they're at 79.99. It's got to be below 80 to get the light pink. So, there's the European areas and U.S., they're getting hit the hardest right now, but not these emerging markets, specifically not so much in Latin America, but specifically in some of these other areas, Asia especially. The emerging markets are actually holding up a lot better. So here's how the sectors are playing out. I talked about that tech leadership continuing to be the case. I mean, look, like XLK is barely below its moving average. XLY doesn't even have a red line yet. XLC is barely below. But look at energy. Now, granted, industrials and materials are breaking down more than they have been. They're finally kind of breaking down here. They're staples. Look at financials, well below and getting a cluster today. Real estate, well below, getting a cluster today. Utilities. I mean, for these areas to be falling as much as they are, utilities and real estate and staples falling, kind of shows it's not necessarily the most, again, risk off type of a move. Let's take a look at the comparison here, and again, just go to that September 3rd time frame, September the 3rd here, and then go to keep it on the hourly chart. Again, there's your 3 area. Energy, of course, declining. You can see what's been holding up well at that point, but if I were to come over here to this latest kind of decline that we had post this rally, so it would be what, September, this would be September the 16th. So we go September the 16th here. Have a little bit of a gain on September the 16th before it finally gets to that point. Let's go to like a 15-minute chart. Okay, so now you look at, okay, the biggest losers during this leg lower was initially technology, communication services, discretionary. Now they're actually up here at the top. Communication services right there, and you have financials, materials, and energy and real estate lagging behind and having the biggest losses. So again, it kind of shows you how the strength of the leadership in this tech space that will allow it to eventually bounce off these lows and lead us up potentially on a new leg higher once again we resolve the margin of safety issues that space has, that large cap tech space has. One area that's actually doing the best during this whole decline here is healthcare. Healthcare is actually kind of holding up. Obviously, it's had its run to the downside, but again, margin of safety, right? Since it's kind of more towards its support, it's not going down nearly as much anymore, while some of these other areas are falling down a lot more and catching down to the tech space. And that brings us to our trade idea of the day, and I want to take a look at a stock that's had a nice little pullback here. And is sitting on a very strong support level itself, and that is Boston Scientific, sitting right on not just the point of control, but there's a lot of volume below that as well. And you can kind of see where it can go, and it's sitting kind of in the middle of its value area, a very sideways range that it's been in for the last so many months, and potentially could come down to the low end of the range, but also can move up to the high. And you notice we haven't dropped below that 0% level, which is also actually another factor on the broader market itself that we haven't had. We haven't had the drop on the broader market below 0 yet that we even got in May of 2019 that we're not getting here that we typically get during intermediate pullbacks. So let's go back to Boston Scientific. You can see it's got its market forecast chart getting dark pink shading and a red line, but again, we kind of had that breakdown The near-term line setting up for a possible divergence there. You take a look at the two-line charts of the three green arrows for Boston Scientific. We are below the moving average. Stochastics is down. We've had a really decent selling, but like I said, to support. You look at its Ichimoku cloud here. Eventually, there we go. You can see we're right at the top of the cloud. We're below the blue line. We're right at the top of the cloud. And you can also see from a DMI standpoint, BSX, we are above 30. We are below 20, but we're not like the positive index is not breaking down hard. We can see it's gone down to these levels before, and that's about where it finds its lows. And we didn't really spike up, just like on the market, on the negative line, like we've seen in other drops that are sharp to the downside. So there's an opportunity for us to hold support. And if it doesn't, we take a loss. But if it does, then we look for not a big directional move to the upside, but at least enough to stay above the support level. And when you're hesitant about the directional move, but you know you got very strong support below you, then that's when we start looking at doing a bull put spread. In this case, selling the 37, buying the 35. You can see where we got into it here. Full position size, so I don't have to worry about earnings here. Going for a 30% return on risk. And then, like I said, that's out of the $1,000 that we are position size to lose. We don't want to lose more than the 357 that we're trying to make. So that way we can kind of keep our risk 1-to-1 in that scenario. If we break, but we know right here is where support is. So if we break down, then we'll lose that 357. But the nice thing is we've got plenty of hedges, at least in our class portfolio, and then actually in our market outlook trades too. We've got a couple of really strong bearish hedges that if we do break down, they'll still continue to make us money. But if we bounce back up a little bit, especially in this stock, because it's got margin of safety, and it doesn't even have to bounce up, it just has to stay up above 37, then we achieve what we're looking for in a stock like this. All right, so that does it for today. So you've heard from me now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there and reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos, as I mentioned before, and join our website at marketscholars.com as well as our Facebook group we created. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.